Here's what I'm watching right now, and it's something that should terrify anyone who thinks the global financial system operates on free market principles. The Bank of Japan, an unelected central banking institution that answers to nobody, is preparing to dump over 83 trillion yen worth of stock market ETFs onto the market. That's more than $500 billion in equities they're about to liquidate. And let me be absolutely clear about what this represents. This is the most blatant example of central bank market manipulation in modern history, and when they pull the trigger on this sale, the ripple effects are going to devastate portfolios worldwide, blow up the yen carry trade that's been propping up risk assets globally, and expose just how fragile and rigged this entire system really is. Let's start with the uncomfortable truth that nobody in the financial media wants to acknowledge. The Bank of Japan has been directly buying stocks, not bonds, not currencies, but actual equity stakes in Japanese companies for years as part of their desperate attempt to prop up asset prices and create the illusion of economic health. Think about that for a moment. A central bank with the power to create unlimited currency out of thin air has been using that manufactured money to buy stocks, artificially inflating prices and enriching the investor class while ordinary Japanese citizens struggle with stagnant wages and rising costs. This isn't capitalism, this isn't a free market, this is financial feudalism where central planners pick winners and losers, and now they're about to unleash chaos because their manipulation scheme has run its course. The mechanics of what they've done are staggering in their audacity. Since 2010, the Bank of Japan has accumulated 83 trillion yen worth of ETFs, primarily tracking the Nikkei 225 and Topix indexes. They became the single largest shareholder in the Japanese stock market. Not pension funds, not mutual funds, not retail investors. A central bank with a printing press. They created money, bought stocks, drove prices higher, and made themselves and their politically connected friends wealthier while destroying any semblance of market price discovery. And now, after years of this manipulation, they've decided it's time to exit. But here's the problem. When the biggest buyer in the market becomes a seller, prices collapse. It's not complicated math. Supply and demand still matter, even in our rigged system. When $500 billion worth of stocks hit the market over the coming years, there aren't enough natural buyers to absorb that supply without prices cratering. But the direct impact on Japanese stocks is only the first domino. The real systemic danger is what this does to the yen carry trade, and this is where the global contagion becomes inevitable. For years, sophisticated investors and hedge funds have been borrowing yen at near zero interest rates, converting those yen into dollars or euros, and investing in higher yielding assets around the world. US stocks, emerging market bonds, real estate, cryptocurrencies, you name it. This trade has been enormously profitable because the yen stayed weak, allowing traders to borrow cheap and invest in assets that appreciated while paying minimal interest costs. But here's the catch. If the yen suddenly strengthens, which is exactly what happens when the Bank of Japan tightens policy, raises rates, and starts selling assets, the carry trade blows up. Traders have to buy yen to pay back their loans, which drives the yen even higher, which forces more unwinding, which creates a self-reinforcing spiral of margin calls and forced liquidation across global markets. We got a preview of this in August when a surprise rate hike triggered a brief but violent carry trade unwind that saw the Nikkei plunge 12% in a single day and dragged global markets down with it. That was a warning shot. What's coming could be exponentially worse. The political implications of what the Bank of Japan is doing cannot be overstated. This is unelected bureaucrats making decisions that will determine whether millions of people's retirement accounts maintain their value or get cut in half. These central bankers, Kazuo Ueda and his colleagues, are not accountable to voters. They're not accountable to democratic processes. They operate in secrecy, make decisions behind closed doors, and then impose those decisions on entire populations who have no say in the matter. And what's their track record? Decades of failed monetary experiments, ballooning balance sheets, zombie companies kept alive by cheap credit, and wealth inequality that's reached feudal levels. The Bank of Japan's balance sheet is larger relative to GDP than any other major central bank. They own government bonds, corporate bonds, and now massive equity positions. They've become the market. And now they're going to try to exit their positions without crashing everything, which is like trying to drain a swimming pool while people are still swimming in it. It's going to end in disaster, and regular people are going to pay the price while the elites who created this mess escape unscathed. Let's talk about the yen itself, because the currency dynamics here are where the real violence occurs. The yen has been historically weak, trading above 150 to the dollar at times because the Bank of Japan kept interest rates at zero or negative while other central banks raised rates. This created a massive interest rate differential that encouraged capital to flow out of Japan. But now they're hiking rates, they're talking about reducing stimulus, and they're planning to sell their stock holdings. All of this tightens financial conditions and puts upward pressure on the yen. If the yen strengthens to 140 or 130 to the dollar, which is entirely possible given the policy shift, every single carry trade position in the world suddenly faces losses. A hedge fund that borrowed 150 yen to get $1 and invested that dollar in US stocks now has to come up with more dollars to repay the same amount of yen. They're forced to sell their US stock holdings, which drives US markets lower, which triggers more margin calls, which forces more selling. It's a doom loop, and the Bank of Japan is about to light the fuse. The arrogance of central bankers thinking they can manage this unwind smoothly is breathtaking. They genuinely believe they can announce their plans, give markets time to adjust, and slowly liquidate positions without triggering panic. But markets don't work that way, especially when everyone knows the biggest holder is trying to exit. It's like announcing at a crowded theater that you're going to slowly and calmly evacuate while simultaneously saying there might be a fire. People stampede for the exits. The moment sophisticated traders realize the Bank of Japan is serious about selling, they're going to front-run those sales. They'll sell first, driving prices lower, which accelerates the selling pressure, which forces the Bank of Japan to sell into a falling market, which drives prices even lower. The orderly unwind they're imagining is fantasy. The reality will be chaotic, violent, and destructive to wealth globally. What makes me angry, and what should make you angry, is that this entire situation was avoidable. Central banks never needed to become equity buyers in the first place. The Bank of Japan's stock purchases were an act of desperation, a Hail Mary attempt to prop up asset prices and create a wealth effect that would somehow translate into real economic growth. Spoiler alert, it didn't work. Japanese GDP growth remained anemic, wages stagnated, and the only people who benefited were those who already owned assets. The central bank literally printed money to buy stocks, enriching the wealthy while doing nothing for ordinary workers. And now that this manipulation scheme is unwinding, those same ordinary workers are going to see their pension funds decline, their cost of living increase as the yen strengthens, and their job security threatened as companies face tighter financial conditions. The elites get bailouts and golden parachutes. The working class gets austerity and layoffs. It's the same story every single time. The global financial system is so interconnected and so leveraged that shocks in one market instantly transmit everywhere else. Japanese pension funds hold US treasuries. US hedge funds hold Japanese stocks. European banks have yen-denominated liabilities. Chinese companies borrow in yen. When the Bank of Japan destabilizes Japanese markets and the yen carry trade, it destabilizes everything. We learned this in 2008 when Lehman Brothers failed and triggered a global financial crisis. We learned it again in 2011 during the European debt crisis, and we're about to learn it once more when Japan's central bank manipulation scheme unravels. But here's the key difference. In 2008, central banks could respond by slashing rates to zero and launching quantitative easing. Interest rates were high enough that there was room to cut. Balance sheets were small enough that there was room to expand. Now, rates are still relatively low, balance sheets are already bloated, and central banks have limited ammunition. When this crisis hits, the policy response is going to be constrained, which means the damage is going to be worse and last longer. The yen carry trade is estimated to be somewhere between 500 billion and 2 trillion in size, depending on how you measure it. Nobody knows the exact number because so much of this activity happens in shadow banking and offshore accounts that aren't subject to regulatory reporting. But what we do know is that it's massive, it's leveraged, and it's going to unwind violently when the conditions change. The people running these trades, hedge fund managers, proprietary traders at investment banks, family offices, they understand the risk. They know that if the yen spikes, they're facing catastrophic losses. So what do? They set stop-loss orders. They program their trading algorithms to automatically liquidate positions if certain thresholds are breached, which means that when the selling starts, it accelerates automatically. The machine starts selling, which drives prices lower, which triggers more selling algorithms, which drives prices even lower. Human judgment gets removed from the equation, and the market becomes a runaway train of forced liquidation. This is modern finance, a complex, interconnected, algorithmically driven system that's designed to amplify shocks rather than absorb them. Let's talk about who gets hurt when this happens, because it's important to understand the class dynamics at play. The wealthy investor class, the people who've been benefiting from central bank asset purchases and the yen carry trade, they have sophisticated risk management. They have access to hedging instruments. They can afford to take losses because they have diversified portfolios and multiple income streams. When markets crash, they might lose 20 or 30% of their portfolio, which is painful but not catastrophic. Some of them even profit from the crash by shorting or buying volatility. But what about the average person? The worker with a 401k who's been told to buy and hold and trust the market. They watch their retirement savings get cut in half. They can't afford to wait years for it to recover because they need that money to retire. And they certainly don't have access to the hedging strategies that protect the wealthy. So once again, when central bank policies fail, it's the working class that bears the brunt of the consequences, while the elites who created the problem walk away largely unscathed. This is why people are losing faith in institutions. This is why populist movements are gaining strength. People intuitively understand that the system is rigged against them, even if they can't articulate all the technical details of how the rigging works. The timing of the Bank of Japan's decision is particularly suspicious. They're making this move now, after years of accumulating stocks, right as global economic conditions are becoming more fragile. China's economy is slowing. Europe is teetering on recession, the US consumer is tapped out, and the Bank of Japan chooses this moment to announce they're going to liquidate their stock holdings and tighten monetary policy. Either they're incredibly naive about the systemic implications, or they know exactly what they're doing and don't care about the collateral damage. My suspicion is the latter. Central bankers operate in a bubble where they're primarily concerned with their own institutional credibility and balance sheet health, not with the real-world impact on ordinary people's lives. They see their bloated balance sheet as a problem that needs to be addressed for technical reasons, and they're willing to trigger a market correction to clean up their balance sheet, consequences be damned. What happens to U.S. stocks when this unwinds? Nothing good. A significant portion of the buying pressure that's driven U.S. markets to record highs has come from foreign capital, including yen carry trade flows. When those flows reverse, when traders have to sell U.S. stocks to buy back yen, that buying pressure disappears and becomes selling pressure. The magnificent 7 tech stocks that have driven market gains, the AI bubble that everyone's excited about, the record valuations that are justified by assumptions of continued liquidity, all of that comes under pressure. And it's not just equities. Corporate bonds, real estate investment trusts, private equity valuations, cryptocurrency prices, anything that's been inflated by cheap global liquidity faces a repricing when the yen carry trade unwinds. We're talking about trillions of dollars in paper wealth potentially evaporating, and the people who will be hurt most are those who believe the central bank narrative that everything is under control and markets only go up. The Bank of Japan's stock sales are scheduled to occur gradually over multiple years, with reports suggesting they'll sell approximately 330 billion yen worth annually. That sounds slow and managed, right? That's what they want you to think. But here's what they're not telling you. The market is forward-looking. Traders don't wait for the actual sales to happen. The moment they believe the Bank of Japan is serious about selling, they adjust their positions immediately. Front-running is the name of the game. Everyone tries to sell before the Bank of Japan sells, which means the impact happens much faster than the announced schedule suggests. It's like a bank run. It doesn't matter that the bank has enough money to eventually pay all depositors if everyone tries to withdraw at once. The perception of risk creates the reality of crisis. The parallels to the Swiss National Bank's currency peg abandonment in 2015 are instructive. The SNB spent years promising they would maintain a floor on the Swiss francs' value against the euro. Traders believed them and positioned accordingly. Then one day, without warning, the SNB abandoned the peg. The franc spiked, traders were blown out of positions, and some brokerages went bankrupt from client losses. The SNB later explained that maintaining the peg had become too expensive and unsustainable, but traders who believed the central bank's promises were left holding the bag. The lesson? Central bank forward guidance is propaganda. When maintaining a policy becomes inconvenient or costly, they'll abandon it regardless of what they promised. The Bank of Japan is setting up a similar situation. They're signaling their intentions to sell stocks and tighten policy. But when market conditions deteriorate, and they will, they'll face a choice: continue with the plan and watch markets crash, or reverse course and lose credibility. Either outcome is destructive. The bigger picture here is that we're witnessing the endgame of the global monetary experiment that began after the 2008 financial crisis. Central banks around the world slashed interest rates, launched quantitative easing, and bought trillions in assets to prevent economic collapse. But those policies were never unwound properly. They just kept going, year after year, inflating asset bubbles, encouraging excessive risk-taking, and making the financial system more fragile rather than more resilient. Now, 15 years later, we're facing the reckoning. Central banks want to normalize policy, raise rates, reduce balance sheets, exit asset purchase programs, but doing so risks triggering the very crisis they were trying to prevent. The Bank of Japan's ETF sales are just one manifestation of this broader problem. Every major central bank is sitting on bloated balance sheets filled with assets they bought during the crisis era, and eventually they're all going to try to exit those positions. The Bank of Japan is just the first to make a serious attempt, and we're about to learn whether it's possible to unwind these positions without destroying the market in the process. My prediction? It's not possible. The system is too leveraged, too interconnected, too dependent on continued liquidity injections to tolerate a genuine policy normalization. The Bank of Japan's stock sales will trigger market volatility, force yen carry trade unwinding, and ultimately compel policy reversal. But the reversal will come only after significant damage has been done, after portfolios have been hit, after jobs have been lost, after political instability has increased. The elites running this system learned nothing from 2008. They responded to a crisis caused by too much debt and speculation by encouraging even more debt and speculation. And now they're going to learn the hard way that you can't manipulate markets forever without eventually facing consequences. For anyone trying to protect themselves, the message is clear. Don't trust central bank promises about gradual and orderly policy normalization. When the Bank of Japan starts selling stocks and the yen carry trade starts unwinding, the adjustment will be neither gradual nor orderly. It will be chaotic, violent, and destructive. Position accordingly. Hold cash or cash equivalents. Consider hedges. Reduce exposure to overvalued risk assets. Don't be the person caught holding the bag when the music stops, because that's exactly what the central banks are setting up. A game of musical chairs where the people left standing when the liquidity drains are going to face devastating losses. This isn't financial advice. This is a warning about what happens when unelected bureaucrats with printing presses think they can control markets through manipulation and then exit those manipulations without consequences. The anger I feel about this situation is not just about potential investment losses. It's about the fundamental injustice of a system where central banks privatize gains through asset purchases that enrich the wealthy and then socialize losses through market crashes that devastate ordinary savers. It's about the arrogance of technocrats who think they're smarter than markets and can engineer outcomes through manipulation. It's about the political corruption that allows these institutions to operate without accountability. And it's about the predictable human tragedy that unfolds when these schemes inevitably fail. The retirements destroyed, the families bankrupted, the dreams deferred, while the people responsible for the mess face no consequences. The Bank of Japan's $500 billion ETF liquidation is not just a financial event. It's a political statement about who holds power in our system and who pays the price when that power is abused. This content is for educational and informational purposes only and does not constitute financial, investment, or political advice. The views expressed represent my interpretation of complex financial and policy dynamics and should not be relied upon for making investment decisions. Markets and policy conditions can change rapidly and unpredictably. Anyone considering financial decisions should conduct comprehensive independent research and consult with qualified professionals appropriate to their specific circumstances.